Welcome to Wonderslate. Subscribe to our YouTube channel for more updates. Topic for today's quiz is Reserve Bank of India. Question number 1. Underscore is the banker's bank in India. Option A. State Bank of India. Option B. Punjab National Bank. Option C. Reserve Bank of India. Option D. Oriental Bank of Commerce. The correct answer is Option C. Reserve Bank of India. In India, Reserve Bank of India or RBI is known as the banker's bank. It is so called because it acts as a bank for all the commercial banks in India. RBI holds their cash reserves, lends them short-term funds and provides them the central clearing and remittances facilities. Question number 2. Reserve Bank of India was nationalized in Option A. 1959. Option B. 1947. Option C. 1945. Option D. 1949. The correct answer is Option D. 1949. The Reserve Bank of India was nationalized with effect from 1st of January 1949 on the basis of the Reserve Bank of India, Transfer to Public Ownership, Act, 1948. All shares in the capital of the bank were deemed transferred to the central government on payment of suitable compensation. Question number 3. Which one of the following is not a quantitative credit control measure of the Reserve Bank of India? Option A. Bank rate. Option B. Statutory liquidity ratio. Option C. Statutory cash reserve requirement. Option D. Moral suasion. The correct answer is Option D. Moral suasion. Bank rate, statutory cash reserve requirement, statutory liquidity ratio are the instruments of quantitative credit control. Moral suasion is not a quantitative credit control instrument of credit control. Moral suasion implies persuasion and request made by the central bank to the commercial banks to cooperate with the general monetary policy of the former. Question number 4. When the bank rate increases, the demand for loans underscore. Option A. Reduces. Option B. Increases marginally. Option C. Remains unchanged. Option D. Increases drastically. The correct answer is Option A. Reduces. Question number 5. Which one of the following is not an instrument of selective credit control in India? Option A. Regulation of consumer credit. Option B. Rationing of credit. Option C. Margin requirements. Option D. Variable cost reserve ratios. The correct answer is Option D. Variable cost reserve ratios. Variable reserve ratio, cash reserve ratio, is aimed to control the only volume of credit, quantitative method, not both volume and purpose of credit for which bank gives loans. Qualitative methods and selective control methods are used for these purposes. It has a number of limitations. Question number 6. Bank rate implies the rate of interest. Option A. Paid by the Reserve Bank of India on the deposits of commercial banks. Option B. Charged by banks on loans and advances. Option C. Payable on bonds. Option D. At which the Reserve Bank of India discounts the bills of exchange. The correct answer is Option D. At which the Reserve Bank of India discounts the bills of exchange. Bank rate is the rate of interest at which the central bank of a country provides refinancing facilities to commercial banks. The bank rate, a benchmark rate at which RBI buys or rediscounts bills of exchange or other commercial papers eligible for purchase. Every bank needs refinancing as it is very difficult to match borrowings and flow of deposits. Question number 7. Buying and selling securities or bills in the open market are called Option A. Cash reserve ratio. Option B. Open market operation. Option C. Bank rate policy. Option D. None of these. The correct answer is Option B. Open market operation. Open market operations are the sale and purchase of government securities and treasury bills by RBI or the central bank of the country. Open market operations are one of the tools that RBI uses to smoothen the liquidity conditions throughout the year and minimize its impact on the interest rate and inflation rate levels. Question number 8. Which of the following methods cannot be used as an instrument of quantitative control of credit by the central bank? Option A. Bank rate policy. Option B. Open market operations. Option C. Changes in margin requirements. Option D. Variations in reserve ratio. The correct answer is Option C. Changes in margin requirements. Change in margin requirements cannot be used as an instrument of quantitative control of credit by the central bank. Change in margin requirement is used as an instrument of qualitative control of credit. The margin requirement refers to the difference between the current value of the security offered for a loan and the value of loans granted. Question number 9. Which of the following is the monetary authority on a country? Option A. The government of the country. Option B. The banking system of the country. Option C. The central bank of the country. Option D. All of these. The correct answer is Option C. The central bank of the country. A central bank is an entity responsible for overseeing the monetary system and policy of a nation or group of nations, regulating its money supply and interest rates. By easing or tightening the money supply and availability of credit, central banks seek to keep a nation's economy on an even keel. Question number 10. CRR according to October 2007 was Option A. 7.5%. Option B. 25%. Option C. 30%. Option D. 2%. The correct answer is Option A. 7.5%. The CRR rate hike will come into effect from April 26 and May 10, with a 0.25% increase in each phase. The central bank last hiked CRR by 0.5% to 7.5% in October 2007 to curb liquidity in the system, even though inflation was hovering around a 5-year low of over 3%. Thank you for watching the video. If you'd like practice this quiz, then download the Wonderslate app now, link in the description below. If you have any suggestion for us, feel free to leave comments. If you liked the video and want to see more of it, hit the thumbs up and don't forget to click on subscribe button to get more updates of the future videos.